quite a while. I think I only had time to do one live stream during the growing months, but as we wind down in growing season for Climate Zone 6, I have a little bit more time on my hands as the crops in the fields don't demand as much my attention. When I do come into this time of the year, I usually spend more time doing stuff like live streams, but when Mother Nature calls, I have to dedicate the time that I would otherwise do live streaming to stuff like gardening and tending to the crop. So it's good to be back. Look forward to doing these on a more periodic basis in the cooler months. Where do we even begin? Well, we came into this year looking for a correction in stocks, and we did get a correction. Admittedly, the correction was a bit more than we anticipated. And that's always the challenge when you are looking to exit long positions in equities. You have to make two decisions. You have to make a decision to get out and then a decision to get back in. So today, without giving away too much of the good stuff, I want to look at some charts. We can start off with the S&P 500. So let me go ahead and pull up a chart of that. We had a pretty good start to the week. Gapped up and closed near the highs of the day, but we are in a heavily shorted market right now, so short squeezes of this sort are not uncommon to see. But the big level for me in the immediate term is this bearish gap down that we saw, a little bit of an island reversal here in early October in the S&P 500. But bulls may find some solace in the fact that we had this wide case of bullish divergence in price from the RSI indicator. But I think the canary in the coal mine, and at least until a potential Fed pivot is in the works, is a seemingly potential breakdown from an inverted saucer pattern. Now we're hovering right around that support zone, so we're not, we did break to a new low last week, but we recovered nicely after the CPI numbers came in hotter than expected. But we are, vulnerable to a pretty nasty breakdown if this doesn't turn into a false breakdown. And as the saying goes, from false moves come fast moves, and I think that's the best hope that the bulls have right now is the extremely high levels of pessimism and bearishness surrounding equities right now. But the big culprit is interest rates. There's not a lot of liquidity in this market right now, and obviously the Fed's raising interest rates. But people keep talking about a potential Fed pivot, and I think that is eventually coming. If you look at the Fed fund futures, there are some signs. Once we get past Q1 of 2023, that at the very least the Fed's going to pause. A lot of these commodity markets are down over 30% from their highs, which does make a lot of these CPI numbers very surprising in a way. Now, granted, those are laggard data points, but crude oil is down from its multi-year high of in March. Over 30%. It's off that low a little bit, but that's the main driver of inflation expectations. So seeing these CPI numbers still come in elevated and higher than expectations is a bit of concern with respect to a Fed potential pivot. Now, the labor market is still strong. Still seeing jobs numbers come in relatively stable, but there are rumors swirling, especially in the tech space, that layoffs are coming in Q4 and in Q1. So, that could be the catalyst for Fed pivot. But what might it look like in the age of higher inflation, in the age of multi-decade high inflation? What does it look like if the Fed does decide to provide liquidity, at least even toward the long end of the yield curve? So we know that the Fed traditionally is operating the short end of the capital market spectrum, working in the 90-day bills and setting interest rates on that front. But I think that with inflation so high, I wouldn't be surprised if they actually launched a new form of QE. I don't even know if they'll call it QE again, but what I would look for if a Fed potential pivot happens is, instead of trying to artificially lower rates, so pushing bond prices down, interest rates down, pushing bond prices high as they can go, I think they would basically try to put a cap on rates and prevent bond prices from falling too much. So that's it is a different strategy. Instead of trying to push bond prices higher, they're going to try and stop them from falling too low. And that is pretty significant when you think about it, especially we look here at credit spreads between investment grade corporate debt and midterm treasuries definitely falling. This was the big warning sign coming into this year. A lot of times you see deterioration in credit before it permeates into the equity market, and that did unfold as such. But some signs that remember, the capital markets are forward-looking, so there are some signs that we could actually be nearing that potential Fed pivot in the next 3 to 6 months. But we're not there yet. In the meantime, we're looking at a 75 basis point rate hike in November. So need to be on our toes for that. So let's take a look at some other indices, starting off with the NASDAQ. NASDAQ outperformed on Monday. That's a good sign. Gapping up to start the week usually is pretty good, but it's better when you're in a bull trend. When you're in a downtrend, this could just be construed as short covering. But I mean, look at these these wide price ranges. I mean, I think it's going to be like this going into election day. And here too, we had that bearish island reversal that we broke down from in the beginning of the month. But when we look at the Dow, we actually closed that gap. So this creates a very interesting scenario, because usually when you see the Dow lead on a percentage basis, it's not as much of a risk on signal. You want to see stuff like NASDAQ, the tech segments of the market lead. At least that's been the case for the last decade and a half. But I do think that we have entered a new macroeconomic regime. That's been our position for quite some time, at least for the last, basically when the COVID lockdowns hit and we saw the supply chains break down, we said, hey, this is going to cause stagflation. We're on record talking about that. But that kind of ended the decades of deflation. The 2000 to 2010 was a decade of deflation for equities. Took the NASDAQ, 14 years to recover from the dot-com bubble. 2010s was a decade of deflation for commodities. And I think we've entered a new cyclical period of inflation, mild to high inflation. And that means that we could see an equity bull market and not have tech outperform. So, but what I think the real opportunity lies in the U.S. equity market. And I actually want to take a moment to talk about some international stocks too, because I think the dollar holds the key to it all, right? Is small caps. We look at the IWM Russell 2000 small cap value ETF. We never took out that low from June, but we did take out that low from June in the S&P, the Dow, and the NASDAQ. And when you see this type of divergence between the indices, that's a really good sign. Small caps have been underperforming for quite some time. It's been, I think, over a year. I can check on that later if I remember. But small caps have been underperforming. We didn't make a new low compared to the June low. That suggests that we could see some leadership emerge from small cap sectors of the market. And coming out of any potential market low, that would be a most welcome sign. So keep an eye on Russell 2000 here, especially with the strength in the dollar that's permeated across the world. It's been basically a global wrecking ball in financial markets for the basically year to date. But historically, we've seen small caps do well with dollar strength. That has not been the case this time around. So that's what we need to keep an eye on, because if the dollar actually does pull back, we can actually pull up a chart. I'm going to pull up the ETF here. UUP. The euro had a good day here on Monday. I do like the potential for secondary lower high forming. I'm not calling for a high in the dollar at all. The interest rate differential between the U.S. and Japan and the U.S. and the euro is still too wide for a meaningful correction. I do think a prolonged consolidation, a new base to be built, would be constructive, allow for some, correlations at a macroeconomic level to realign. We can rally, stocks can rally with a strong dollar. It just depends on the macro environment. But if rallies actually start by a sell-off in the dollar. So even if the dollar UUP corrects down to 28, 29, it doesn't alter the trend. We got the dollar index to give you more concrete numbers, but I don't think the data is updated yet. It's not as of the close. I mean, as long as the U.S. dollar is above 108, path of least resistance remains high. But I do think a correction down to that level would bode well for equity. So before I get too much into macro, I'm not going to make this the longest stream I've ever done. But I talk about some opportunities across the world, especially in Turkey. So good old Anatolian Peninsula there, where Erdogan has been the president for quite some time. Turkey's been in the headlines in recent years, not for many good reasons. Turkish lira basically suffering from hyperinflation. They Turkish central bank raised interest rates as high, I think it was 24% in 2018 or 2019. They're still in the double digits. They're in the teens, 12, 13%, but they're actually easing. And so I think this is actually turning into a very strong boon for the equity markets. And if we look at this weekly chart here, I mean, this looks like we're about to break out from a massive multi-year rounding bottom. And I think that Turkey is offering some of the best risk reward opportunities in the global equity market right now. So even if the Turkish lira is losing ground against the dollar. The central bank is easing. It's bullish for the the equities there. Just make sure you're paying attention to the currencies because we have to remember we're looking at real returns, not nominal returns. So I like what's going on in the Turkish lira. You can see it had a very strong day here on Monday, up 8%, gapped up and closed near the highs of the day. So we do have positions in TUR. Mentioned this in the chat room as well. So definitely keep an eye on this. If we clear 28 here, look out above because I think this thing is going to the mid 40s to say the least. Some other opportunities that I have been looking at actually relates to India too. You can see that it corrected. The Indian market corrected in a much cleaner pattern compared to U.S. markets. Within this descending price channel here, it's not as vertical shaped as the U.S. markets one. But I do think India, especially if the dollar sells off, there will be some tremendous opportunities in some foreign markets. So we need to be aware of that because in the last few years, we've been rewarded for our bias towards U.S. equities. But a lot of times when you come out of important market lows, you see the correlations change and outperformances change and whatnot. So it doesn't mean that we're out of the woods yet. In fact, I shared that in the S&P, we could see much lower prices. Perhaps I didn't even provide the downside objective. I wouldn't even be surprised if we do see a more definitive breakdown from this inverted saucer that I pointed out earlier in the stream. That could take prices down to 3,000, 3,200. But we start closing above 3,900 in the S&P. I think that changes the game and looks more like a false breakdown. So that's all the time I had for today. Then you can check out my work through two main avenues. Still, working with the Mercator, but MMAcycles.com and Benzinga.com. We have a variety of reports and publications and videos and chat rooms going on those fronts. So check those out. Both very good friends of mine. So that's all I have for now. Thanks for watching. And I will be back more periodically, as I mentioned, in Climate Zone 6. The growing season is winding down. So thanks for watching. See you soon.